Okay, so I want to talk about the case study, which we'll be going through for the next couple weeks, or next couple days, well, week and a half, which is the merger of Office Depot and Office Max. And it always usually starts with a press release, right? Whether you're analyzing this a situation for pro forma analysis or as a comp, for whatever reason, you'd want to look at the press release. And this is what the press release states, and the important thing to extract from the press release is what type of transaction is it, and how is the purchase price calculated, how is it funded. So right now, this is Office Max and Office Depot announced merger of equals. What's a merger of equals? Yeah, which all mergers basically are, right? Because if one company is clearly dominant, then it becomes an acquisition. So they're just being descriptive there. But different from a consolidation, which is, what's the difference between a consolidation? What's the difference between consolidation and a merger? One, you have a brand new entity being created. Albert, what was your question? Well, we're going to use Edgar in a second. Yeah. What is what called? The what? Oh, the document. Oh, this is probably in an 8K, which is just a general news announcement form. But we'll go through those documents on Edgar in a quick second. So they announced merger of equals to create a $18 billion global office solutions company, two leading companies to combine and build a stronger, more efficient competitor, and to meet the growing challenges of a rapidly changing industry. Is this horizontal or vertical? Horizontal. We talked about that because they're competitors. Increasing market share. Notice combined company position for sustainable long-term value creation. Anticipated annual synergies of 400 to 600 million. So synergies seems to be a major driver to this type of merger. It usually is a major driver to a horizontal merger, right? Either increasing in market share, finding synergies to have a newly combined, more profitable entity. We're going to model that out to see how impactful that truly is. So the point of going through these cases is to really back into what's the driver, right? What's the impact? What's the motivation behind this type of merger? That's what I want you to think about. And that's why it's important to illustrate how to do mergers on the board first so we can get a high-level understanding of what the key drivers are behind a merger before getting caught up in the nuances of income statement, cash flow statement, balance sheet mechanics, right? So the other thing you want to think about is not only the subjective side of it, but the purchase price. What's the combination, right, from a financial perspective? So do they give us... I thought this way. Yep. Okay. So under the terms of the agreement, Office Max stockholders will receive 2.69 Office Depot shares for each share of Office Max common stock. So what's the purchase price? How do you go through thinking about that? What do you think? How would it be funded? Sources and uses. What's that? Equity. Why?
Because it's just a like share swap.
It's a stock swap. It's a stock swap. So what do the uses look like? How would you think about the uses in a stock swap? Well, let's look at it. So let's not. This is a good time to jump to the model. So here is a semi-basic merger model. Hopefully you guys could start to look at this, where we have laid out an assumptions tab, and I want to just look at the assumptions tab. I want to look at how to infer from these from public documents and public information. How do you interpret this stuff for solid purchase price, uses and sources, which will be used as a basis for understanding our merger and potential accretion dilution of the company. Notice we have a model for Office Depot already built out based on street estimates at the time. Full income statement, cash flow statement, balance sheet, and the supporting schedules, depreciation schedule, debt schedule, working capital schedule. Notice we've stacked the schedules, unlike the Walmart model where we had a separate tab for each schedule. I recommend to stack them and try to line up the line items of the acquirer and target companies as closely as possible to make the roll-up or merger easier, right? Same thing with Office Max. We have the Office Max, revenue, COGS, income statement, cash flow statement, balance sheet, all the way down. And then we have a consolidated financials tab where we will do the merger. So we're going to merge not only the income statement, but the cash flow statements and the balance sheets. And notice here is balance sheet adjustments. This is where we're going to go through a pro forma analysis, merging the balance sheet, which will be a little bit more complicated, and the supporting schedules. So we're going to go through that process and how that works, starting with the assumptions tab. Okay, so first I want to talk subjectively about the situation. I want to talk about how we can lay out the assumptions, sources, and uses. And then I want to talk about how this merger model differs from the type of analysis we've done on the board to help you think about how to properly put this together. Right? So first of all, who's the acquirer here? Whoops. Say it again. How do you know that?
Because the shares that Office Max stockholders receive are going to be Office Depot there.
Right. So Office Max stockholders are the receiver, right? Their stockholders are getting purchased, swapped out. Office Depot stocks will remain. So what does that mean from the purchase price, right? So what I would do before getting into that is I'd first pull up Edgar, go to sec.gov. I'd search for Office Depot or Office Max. And just kind of going back in time to when we started analyzing this transaction, which is around April, May, there's a bunch of documents that existed at the time, and you want to dig into the one that really reflects the merger. How do you know? Well, it'll talk about the merger, and you want one that has kind of solid financials. So you find a lot of documents floating out there. A lot of them will just be copies of the press releases in forms of 8Ks. A lot of them might just be notes on management turnover or options being affected, any kind of byproduct of this merger. But you want a proxy document. So I mentioned proxies before, right? A proxy document is a solicitation to the shareholders to either vote for approval for the merger or to vote for their approval for other pieces of the merger. And that proxy document will contain a couple of really important sections, one being financials at the time of announcement of the merger or close to it. And two, something we haven't talked about before, but a fairness opinion. You guys know what a fairness opinion is? It's supposed to be a third party evaluation of the company or the transaction. And the benefit of the fairness opinion is it's supposed to be unbiased. So Office Depot has an advisor. Office Max has an advisor. And a lot of times Office Depot's financial evaluations would be in favor of Office Depot's, of their client. And Office Max, the Office Max advisors' valuations would be in support of their client. So there's usually, or traditionally, there's a third bank that would post their valuation for public consumption for shareholders that's supposed to be fair and unbiased, not leaning towards one side or the other. That's a fairness opinion. And the benefit to us about having a fairness opinion, which is unique to just financials, is it contains projections. It contains accretion dilution. They're doing the same analysis that we're doing. So we want to use the fairness opinion as a guide to see how close we come. It's a good proxy for us to determine how they're thinking about the projections and things like that. So we're going to use their projections and tie them close to ours and see how close their accretion comes to ours. That'll help us figure out how they're thinking about it and is this realistic. So you poke around a lot of these items. You have an 8K here, and if you click through, you'd see, let's see, what's this 8K say? This 8K says, all right, this is a departure of directors, certain officers. It's just a page. This isn't what we're looking for. We're looking for a big document that has financials, okay? So you look at, okay, preliminary proxy statements. Okay, that's a proxy. That sounds interesting. We'll go in there, Office Depot, and this looks interesting, but this doesn't look like it's pertaining to the merger. You'll know it. It'll say Office Depot, Office Max, voted for shareholders vote. This isn't that. This is something else. Capital Partners, some other stuff that's unrelated. Here's another proxy, 422, and you can kind of poke around, and it took me a longer time than I'm illustrating here to actually get to the right document, but after poking around, you'll know when you hit the right document. When you go to, this says prospectus business combination. I thought there was one a little bit Let's try earlier than that. We can try this one. I had it open before I flipped back to this. This isn't quite it, right? This looks like it could be it, but it's just a page. Obviously, you can go into the back notes, but here it is. Registration of securities business combinations, April 9th. So it took me a while to get to this document, but I knew this was it because when you scroll down the second page, here you go, Office Depot, Office Max. Proposed merger, your vote is important. Right? Everything what I said. Had the logos, it's talking clearly on the first page, this is about the merger, this is for the shareholders, this is going to have the fairness opinion, this is going to have consolidated financials. Okay, and so without having to read through all this, they basically explain the situation. Right? Office Depot or will be converted into the Office Max will be converted into the right to receive 2.69 shares of Office Depot common stock. So we can use this to lay out the purchase price. While scrolling through this document, and I'm not going to scroll through the whole thing, but just major points, this is just an explanation for shareholders. What does this mean? What is this for? Right? What are we supposed to do? So here's table of contents. Why am I receiving this document? How important is my vote? Why have the companies decided to merge? And you really want to scroll for just key financials. You can go in and look at subjective stuff. There's risks in here, things that might be more interesting if you're putting this together to some sort of pitch presentation. Here are the advisors. Opinions of Office Depot's advisors. Fairness opinion, right? Opinion of Morgan Stanley. So I mentioned that the fairness opinion should be a third-party, unbiased recommendation. This has evolved to now you usually have 3 fairness opinions. The opinion of the acquirer's advisor, the opinion of the target's advisor, and this third party is supposed to be unbiased opinion. You can look at all of them. So as we scroll down, here are some key financials. Better basic earnings per share. If you scroll down further, and it takes time to kind of, get used to this document, and you will become familiar with these documents if you're modeling this out over time. And notice there's a lot of blanks that have been filled in, right? This is a preliminary proxy. They're required to submit this. Over time, as the mergers close, these pieces get filled in. But if you're staffed with trying to reassemble this upon announcement, you can only deal with the information given at the time, so you have to piece it together. This is the structure, transaction structure. We won't get into that detail. We won't need to. We're just focusing on the major impacts. And I just want to show you a couple things that we'll use. Here are projections. So we can run sensitivities to match these projections, which we may do. Office Depot management, Office Max management. You want to do maybe Office Depot, Office Max, average, street. You want to run several cases. And here is accretion dilution. So they're saying that the company is somewhere between 154 and 80% accretive. Very accretive. Why is this very accretive? Is this normal? Is it unusual? We're going to analyze that. What's driving this accretion? So it's got to be the synergies. What happens if they have no synergies? How significant is the synergies? These are the questions you want to be asking. This is the reason. How significant is that driver? Is it important? So we're going to look through that. And if you continue to scroll down, and you usually spend a lot more time looking at this information, and this was the fairness. So I went through it real quick, but this is the fairness opinion, right? These are their multiples, how they arrived, and you can kind of spend a lot of time going through this if you choose to. But we're just going to jump to the important data because we're going to create our own analysis and then try to kind of go back and see how accurate it is in relation to their analysis. But one important thing that I think is very helpful is, as we scroll down, sorry for the delay. Okay, so here's a combined balance sheet. So we're going to do our own pro forma balance sheet, but this is important. We will refer to this. Combined income statement, also important. We're going to refer to this, but we're going to make our own combinations at first, and then here. Estimated value of Office Depot common stock to be issued. This is their purchase price. This is how they arrived at their purchase price. Now, you don't need this to back into the purchase price if you understand how stock swaps work. I mean, we've kind of done some on the board. But this is a good guide for us, and there might be some adjustments and things like that that we'd look for. So the first thing that they mention is, here's the exchange ratio, 2.69. They mention the number of Office Max common stock outstanding as of April 4th, 2013. So they're doing everything as of April 4th. That announcement document was, I don't remember what time it was. Okay, so February 20th. So that was an older document, but this is the most recent proxy that I got at the time of putting together the book. So we want to back into their numbers as of April 4th. Then they have Office Max common stock options, Series D options. So they total this up as Office common stock to be exchanged. So the good thing about this is these are the diluted shares to date. We do not have to dilute the shares. If they didn't have this stuff, we would have to dilute the shares by going through option tables and doing the whole treasury method ourselves. So we do not have to do that, which is the good news. So this table is helpful in that, and I'm not going to bother going back into that using the treasury method. So they have given us the total number of diluted shares, including in-the-money options, and converting their preferreds, any preferreds that are convertible, and any other exercisable options or warrants. So that diluted number went from 86 for basic to 92,749. So we're going to use that as the basis to estimate the purchase price. So if you see, the first thing we've done is we laid out the purchase price box, similar in fashion for a stock swap. So the Office Depot, first we want to lay out the market value, right? The Office Depot share price and the Office Max share price, but we can hard code right in the Office Max diluted shares outstanding, 92,749. And I footnoted where that came from. Always important to footnote where that comes from. Which it should say, I don't know if there's a little bit of slowness here, but it should say, and footnote from the S4. Okay, so that's kind of slow. I don't know why that's going on. What's going on there? So then we have the exchange ratio. And so the exchange ratio is the Office Depot shares as per S4, page 1. Okay, I said page 1. Yeah, this number was also listed all around the first page. I overlooked that. We'll go back to that in a second so I can prove it to you. But at the bottom, they also listed exactly the number of shares. But it's laid out more effectively in this table. We'll go back to that to prove it to you. But the exchange ratio is 2.69. So Office Depot shares offered per Office Max shares, 2.69. Right? And so the total Office Depot shares offered is the product of the two. Right? So 9246 times 269. So we'll multiply. Right? You have 2.69 Office Depot shares for every 92,000 shares. You multiply. This is kind of what we did on the board. So there's 249,494.8 Office Depot shares being offered for this deal. To get the total offer price, we need to know at what price is Office Depot trading right now. Or to be accurate, not right now, but as of April 4th, 2013. So I went to Yahoo Finance, I downloaded the historical stock prices, and I got, I should have had the page ready. Does anybody have it in the book? Chapter 6. I got $3.77. Yeah. I also went and looked for what the Office Max share price was. Even though it's not required for the calculation, it's important to see what type of premium they're effectively paying. And that came out to be $11.21. Okay. So So the purchase price is the product of what? How would you estimate the purchase price, Albert? Yeah, so the Office Depot shares offered times the Office Depot price per share, which is $940,595.4. And is that a little off? Nope, that's exactly what this is. 540,592. Did I transvert this? It should be exactly 7292749,269,940,592. Why is it different? I've never noticed it was different. Did I assume it was a rounding? 940,595.4. I don't remember that being different. Yeah, I guess I assumed that was rounding. That's fine. 94059. I had done the whole book to a decimal, so it didn't come through that there was a slight difference. Okay. What else? What's the next step? So does everyone understand how the purchase price works? So if you are Office Max, you're on the receiving end. Office Depot is offering 2.69, so a multiple, not 0.5, right? Like on the board, it's 2.69 Office Depot shares for every one Office Max share. So for every one Office Max share, you're getting 2.69 shares. So if there's 92,000 shares out there, you're getting 2.69 times that. So I'm saying, okay, so how many shares are going to be offered? I multiply to get there's 249,000 shares offered. Right? You multiply that by the share price of Office Depot. So what's that worth in total? That's $940.6 million. Okay, question on that. What does this mean for the sources and uses? How do we think about sources and uses of cash? So first of all, the purchase price, and I clearly laid this out as equity value of Office Depot shares being offered. This is the purchase price, right? What about the net debt? What do you think about the net debt? How do you think about assuming the net debt? So it looks like, just a clarification here, this is one thing you got to be careful of, and I had to go back. This model is in billions, right? Office Depot and Office Max are modeled in billions. That purchase price table was in millions, so you don't want millions of a purchase price and then have a model in billions. So this 92749 should be really 92.749, and that's where you didn't really pick up the difference in the decimals. 92.749, just to keep everything into billions. Sorry, millions. So 940.6. So sorry, this is in thousands. The Office Depot Max was in millions. So now we're on the same page, $940 million, as opposed to this is 10,695 million. This is 10 billion. So you want to be on the same page. Otherwise, that would have looked like $940 billion, right? Okay. So, what do you think about the net debt? How would you imply, how would you figure out as an analyst if the net debt needs to be part of this, absorbed into this? How would you think about this? How would you know? How would you guess? What would you look for? Yep.
Like you can get into the annual report.
And what would you?
They have like that payment.
Yeah, we want to first look to see if they have debt. That's right. Do they have debt at all? And then if they do, then you got to kind of deal with that.
Can
Hmm?
can you total purchase price of that equity part?
What do you mean? Well, this is the equity part. Okay, so that's a good point. So how do you know that this is equity? It's a stock swap. So that's one indicator here. This is a stock swap. So you got to know that this whole entire 940.6 is going towards the purchase of the shares only. None of that can be going towards debt. So a lot of times transactions and acquisitions will be worded a little bit differently. They would say, company A is buying company B for a 25% premium above the current stock trading value, which is a total value of $1.2 billion. Including debt, it's a total consideration of $1.5 billion. So there is an indicator that they are paying the debt on top of that. If you look at the press release here, and even if you dig in further, there's no indicator like that there's a total consideration in there. So, key strategic benefits, they would say something about paying down the net debt, paying down the target net debt. I thought there was another stronger indicator. There's somewhere it says that the transaction value is approximately $1 billion, which matches the purchase price that we have, exclusive of debt. So it's an indicator that they're not really paying down debt. So you would see, and we'll look at it when we see Heinz and we look at the other kind of cases kind of down the line over the next weeks, you'd see there's buzzwords like total consideration or including assumption of target company's debts. I'll show you a few others where you would infer, that their debt has to be included. Or even better, often you'd see something that says the merger would be company A is acquiring company B for a total value of, let's say, $20 billion. And you do the purchase price, and the purchase price comes to $15 billion. So okay, where's the difference between 15 and 20? It must be because they're also assuming the net debt. Are you okay with that? You got to infer the wording. Another clue is going to the balance sheet. And if you go to the balance sheet here, we're not going to model this. Well, we're going to model a big portion of it. But if you look at the target company, and if you look that it has debts, it does, long-term debt, where's non-recourse debt. These are this long-term debt, for example. It's not being paid down. Okay, a little piece that might be like a fee or an expense. It's staying on. If it's going to be paid down, you see a big portion of it here. This is an increase in debt. This is probably debt that the company is raising. What other debts do they have? Was that the only? Short-term debt. None of it's being paid down. If it was being paid down, you'd see a minus here. So what you're looking at here is you're looking at Company A, Office Depot, Company B, Office Max, any adjustments. This is where the debt paydowns or increases would occur, and then the final balance sheet. We're going to model this on our own, but if they were paying down the target company's debts, you'd see minus 10,232 here, right? Indicating that they're paying down the debt. You'd see, where's the other debt? Minus 225 here. There's a minus little. If you read into the notes, it's like a debt adjustment. So if you're looking at modeling out a transaction and you want to determine if the purchase price includes debt or not, number one, you want to read between the lines. So if you read the headline, right, they would say total consideration or assuming XY company B's net debt, or you can look at the balance sheet and see if they're actually indicating paying down the net debt. Did you have a question, Matt, or somebody? Yes, Peter.
That's a question. When you find out that the purchase price is exclusive of the debt, you would have to go back and adjust the purchase price so that they go with the debt. How does that work?
So the purchase price you're always going to calculate based on some sort of share driver. So here's another indicator. If they say that it's going to be like I said before, if it's like a $25 billion merger, and you calculate the purchase price, and the purchase price only comes out to be $20 billion, and you show that the purchase price calculation is correct, that difference must mean they're assuming debt. So that's what I mean by kind of reading between the lines here. So in this case, there's no indicator of assuming debt. We looked at the balance sheet. They're definitely not paying down debt. And because it's a stock swap, this is another indicator that this 940.6 is only going to the shares. This is an exchange of shares. If they were going to pay down debt, they would need to find other ways to gain funds, and there is no indication of that by reading the press release, and there is no indication of that by looking at the balance sheet. Okay on that? So the net debt is 0. Transaction fees, this is difficult. They're never going to really lay out these are what the transaction fees are, especially in the beginning of a transaction, because you never know. You have to estimate what the transaction fees should be. I think I put a table in here that typically estimates where transaction fees go. It could be anywhere from 1 to 5% on smaller transactions, to 0.1 to 0.5% on large multi-billion-dollar transactions. So big multi-billion-dollar transactions, it's usually like 0.1 of purchase price. So since this isn't a multi-billion-dollar transaction, but it is a $1 billion transaction, I conservatively assumed 0.5%. That was the most conservative of the multi-billion-dollar range, but you would never be expected to really know those numbers offhand. So I'm going to assume that 0.5%. And you can always, as analysts, you're going to start to realize there's a lot of things you're not going to know in terms of assumptions, but just get things in there and start getting the model start building the model out, and then go back and say, well, I made a guesstimate on this and a guesstimate on that. And even if you're ballpark, at least it shows that you're thinking about it as opposed to waiting for your associate. You know what I'm saying? So the transaction fees are going to be 0.5% of the equity. And so the total uses is going to be a sum of all these three components. Okay? And so the question is, how do we think about this for sources of cash? So we have a couple components. We have the purchase price and we have the transaction fees. So how do we think about purchase price and transaction fees when thinking about the sources? Where would it come from? Where could it come from? I'm just going to save this. What do you guys think? There's one thing we definitely know without even having to look further. So merger model, July 16th. What do you know? Based on the examples we've done on the board, what about that? It's got to be stock. Purchase price has to be equity in this case because it's a stock swap. Because of the nature of the stock swap, those funds can only go to shares, so that 940.6 can't go to transaction fees or debt because it's a stock swap. And it must be sourced from shares because it's a stock swap. So that kind of makes it easy for us. Now the rest we don't know because we kind of made up these transaction fees. There's no indicator of transaction fees. We know that there's got to be transaction fees. So it was a toss-up as if this transaction fees will be raised in debt or cash on hand. But it's such a small number relative to what they had. So if you look at Office Depot's financials, they have how much cash? $718 million in cash. So in my opinion, we could have said that they were going to raise $4 million in debt to fund this. They very well could have. We have no idea. I assumed, so what I had done was just to be different because, so $718 million is a lot. But if they were to pay down debt, where the debt was $800 to $1 billion, that wasn't going to come from the cash. Maybe a portion of it was, but they were clearly going to have to refinance that in some way because the amount of target debt that was on the company's balance sheet was greater than the cash in the company's balance sheet. So the way I assumed this to be different and kind of clean was I assumed that if they were to raise, to pay down net debt, they would refinance that, so that would come from debt. And so then I therefore assumed the transaction fees would come from cash on hand, just to be different. I don't know, right? When you slowly start to gain more information on this, you can easily swap those items. I could have very well have said that I'm going to raise everything with debt, the net debt plus the transaction fees, but I want to utilize all three categories. So I said, all right, well, if there is any net debt, which is not, but it's good to set up the model so it has that flexibility, I will raise debt with that, and use cash on hand to pay transaction fees. That's just the way I lay that out. Very clean and simple. We'll get more complicated when we look at LBOs. And of course, you have the total sources match the total uses. And the percent of total capital is just a quick way of looking at what percentage is being raised with equity, what percentage is being raised with debt. And this is kind of trivial because it's like 99.7% equity. But in more complex situations like leverage buyouts where there's a lot of debt, it's important to see the percentages. So I'm going to look at the equity as a percentage of the whole in each category. So 99.5, debt as a percentage of the whole, which is 0, and then cash, right, which adds up to 100. So that's pretty straightforward. So this is a stock swap, so it's a little bit more straightforward, but the real kind of piece that I want to give you here is how do you kind of start opening up the documents, looking through the documents, reading between the lines to infer what the sources and uses could be. And there's a way to infer that by just reading the type of transaction that it is. Any question on that? So focus for this weekend is really to understand the mini merger modeling. On Monday, I want to talk about how that differs from a full-scale merger model. And I want to go through how to start putting together this income statement. Okay, see you Monday.